The Fed just broke the damn markets. They have announced higher for longer, and I want to talk about what the heck that means and the implications for the markets moving forward in this high interest rate environment. Before we dive into that, smash thumbs up button if you like this kind of content. Subscribe to the channel if you're not subscribed already so the YouTube algorithm can feature more of this great content. Let's get it. So, the Federal freaking Reserve, man, Jerome Powell, the master of money, the master of the universe right now. They have not hiked interest rates. That's one of the key things to understand about today's announcement. Interest rates have not gone up, but they are saying that, yes, we are going to do higher for longer. This is, of course, very problematic for the markets right now. But here's a quick summary of what's happened. So they are pausing no interest rate hikes this month. They're leaving their interest rates unchanged at 5.25 to 5.5%, which they're currently at. Most Federal Reserve officials, so 12 out of the 19 Federal Reserve Board members, are seeing one more interest rate hike coming. Federal Reserve's also looking at rates being higher for longer. That's very problematic for a variety of reasons, which we're going to be covering momentarily in this video. They do, however, see inflation at 2.6% in 2024. So the Federal Reserve is currently confident, if you can trust them, of course, that interest rates are going to be sufficient to bring inflation down in 2024. Will they be successful? Time remains to tell us the answer, of course, but this is what they are currently looking at. Now, how is the market pricing all of this in? Well, here's what's very, very interesting. So the Fed's current projections for the Fed fund rate, 5.6% at the end of 2023. That means one more hike. 2024, it'll only come down to 5.1%, so a very slight interest rate decline. That is definitely higher for longer. A whole nother year of interest rates over 5%. That's going to have some pretty hard knock-on effects on, well, everything in the economy. End of 2025, only down to 3.9%. That's still higher for longer. Remember, we just came out of an environment where we had interest rates basically at zero, well, almost zero, but damn low. Holy cow. Now we're getting this. Pretty crazy stuff. Now that's what the Fed's saying. The market's expectations, slightly different. So the market's current expectations, 5.4% for the end of 2023. So actually no more hikes. So even though the Federal Reserve is saying we're going to hike one more time, or at least most of the Federal Reserve is saying we're going to hike one more time, the market's saying, nah, you're bluffing. We don't think there's going to be another hike. End of 2024, they're looking at 4.7%, so that the Fed will actually be forced to make those cuts in 2024, and that we are going to see interest rates below 5% by the end of 2024. Although, interestingly, the market, and this is a long time out, mind you, for the market. These markets change very quickly, so you can't have to take everything here with a bit of a grain of salt, right? And in 2025, 4.4%, which is actually above the Fed's expectation. So that's pretty interesting. And before we break down what the heck all of this stuff actually means, I want to remind you to get signed up for the Wealth Mastery newsletter, man. If you are investing in the cryptocurrency space, you're interested in investing in the cryptocurrency space, you want to know what's going on with the crypto news, macro news, altcoins, DeFi, NFTs, all that fun kind of stuff, well, you got to get signed up to the Wealth Mastery newsletter. Best damn newsletter in crypto. My team and I spend like 40 hours every single week putting this together for you, finding all the best information from across the crypto space, delivering it to you in an easy-to-read email to your inbox 3 times per week. Join our 75,000 weekly readers for free by using the link down below in the description. Now, what's all this stuff mean? What's actually going on here? So, as the Beasley letter points out, Fed futures now no longer show rate cuts beginning until September 2024. That's a long time away. So we are going to be very high for a very long time, according to futures predictions, right? And predictions, of course, are just that. But to put this in perspective, 3 months ago, futures were expecting 4 rate cuts in 2023. That's insane how quickly expectations change in the predictions of where the Fed is going to go, what the Fed's going to do. And of course, While current expectations are not showing a rate cut until September 2024, all you need is a quick recession, and the Fed's going to have to start cutting rates real quick, real hard. Remains to be seen, of course, if we get that recession. Some people say we will, some people say we won't. Who's going to be right? Nobody really knows, but most of the money right now is on a recession is still coming. We're just currently experiencing the lag effect of all these interest rate hikes and the high inflation, all that kind of stuff. So right now, the expectation is that interest rates are expected to pause for at least a year. That's pretty crazy. Higher for longer is here to stay. The preference from the Fed is to send us into a recession rather than risk inflation spiking up again. Remember, this has been the Fed's goal for a very, very long time. They have stated this very, very clearly. They want to get inflation back down to 2%, and they're willing to do whatever it takes to make that happen. Higher for longer, more interest rate hikes, whatever they need to do. They are committed to slowing things down, to fighting inflation, and a big part of that is probably going to be causing significant economic pain, as they've said multiple times. That means unemployment rates go up. That means people lose their cars, they lose their homes, all this kind of stuff. Companies go bankrupt. This is what the Federal Reserve is doing. The Federal Reserve is causing this slow motion train wreck in the economy, trying to fix the harm that they did when they lowered interest rates so low during the Mexican beer crisis, and when they printed, of course, trillions of dollars and handed it out to their buddies. You are now the one having to pay the cost for that. They gave you a one-time check. All their buddies got to raid the Federal Reserve and take trillions and stuff it into their own pockets. That's how the system works. It's crazy. Crazy stuff, man. 2 years ago, when CPI was already above 5%, this is from Charlie Bilello, the Fed was forecasting rate hikes to only 1% by the end of 2023. Even when inflation was staring them right in the face, they did not see it coming, which is why you shouldn't put any weight on their forecast today or any other day. That is a very, very interesting point, I think, to make, is that most of what we have heard from the Federal Reserve, aside from their actual actions of raising interest rates, right, quantitative tightening, all this kind of stuff, their actual actions are one thing. What they say, especially their predictions for the future, are to be taken with a big fat chunk, like, basketball-sized grain of salt, because they've been so wrong so many times. Remember, inflation was transitory, and then all the other stuff. So in terms of, again, putting weight on their forecasts, definitely something that should be looked at with a bit of skepticism here, because there's their actions and then there's what they say, and the two things often do not align. So keep that in mind. Now, this is very interesting as well. Jerome Powell saying that a soft landing is currently not the baseline expectation. They're saying, well, look, there's a lot of factors outside of our control, and that a soft landing is no longer the baseline expectation. That means, let me translate for you. Soft landing not being the baseline expectation means that the baseline expectation is a recession, a hard landing. How hard that landing is remains to be seen. Of course, the Fed still wants a soft landing. They want their fantasy world where they can do all this craziness, cause all of this damage, send banks into bankruptcy and send people into bankruptcy and send companies into bankruptcy and cause all kinds of chaos and drama in markets, and then everything to just be fine. We'll have a soft landing and everything will work in a nice, orderly fashion. Markets aren't generally orderly. This is one thing we have definitely found out for markets over time, is that uncertainty reigns, predictions are hard to make, and there is nothing damn orderly about the way markets work. And that when you have the Federal Reserve looking at everything with a sledgehammer and smashing stuff, seeing what will break, well, stuff breaks, and the consequences can be pretty dramatic when that happens. Also worth pointing out here, the Federal Reserve currently says they don't see a recession until at least 2027. Can you believe the Fed? Well, it would certainly be interesting if we didn't have a recession until 2027. But I'm not sure we can believe them. There's so many indicators saying that there could be a recession coming much sooner than that. But again, we really can't trust anything the Federal Reserve says. It's just a lot of noise, as Satoshi Flipper points out here. Remember last year when Jamie Dimon said a hurricane was coming this year? Where's that hurricane been? Stock markets have gone crazy. Yeah, I know there's been drama with the bond markets. I know there's been drama with the real estate markets, but stocks went nuts. Crypto hasn't done anything, of course, but stocks did really well. Remember also last year when 98% of all American CEOs, according to the Wall Street Journal, were predicting a recession this year as well? Where is it? Where's the recession? Where's the recession? Everyone's wrong all the freaking time in the markets. Just one of those reminders that you don't have to be right all the time in the market. In fact, nobody is right all the time. And if somebody tells you they're right all the time, they're lying to you. The question in markets is, can you be right enough to make money? That's really all that matters at the end of the day. You're going to be wrong a lot. You need to cut the losses, let the winners run, all that kind of stuff. Will the recession really be delayed until 2027? I mean, if that's the case, man, markets have a lot of runway. Got the Bitcoin halving next year. We got all kinds of stuff that could see markets do very well potentially between now and a potential recession in 2027. 2027 is so far away. Very, very interesting. Also, this is a great point here from Stackholder. He says, I didn't believe you were going to do it, Jay Powell, but I believe you now. You really will accelerate the debt spiral by forcing the U.S. to roll over 44% of its debt at 5% rates while running multi-trillion-dollar deficits. That is a crazy, crazy reality because remember, a lot of that, it's not just corporate refinancing that's coming up is going to have to be done at higher levels, which is going to really put a lot of burden on corporations that brought a lot of money when it was much cheaper. Now they have to refinance, and they're going to have a lot more of their bottom line going to pay off this refinancing of debt, which means they're going to have to downsize and et cetera, just at a time when sales are falling because of inflation and all the other stuff going on. People don't have a lot of extra income. Crazy stuff. Now, of course, what's all this actually mean? What's higher for longer really, really mean? Well, here is the simple breakdown of it. Higher for longer, of course, as just mentioned, means a bigger problem for America's $33 trillion debt bomb, which is going to see even more burden put on U.S. taxpayers over time. Less stuff for you, fewer road repairs, less money for your kids' schools. I mean, there's already not enough money for any of that stuff. Apparently, there's always infinite money for war and stuff for your kids' education and stuff. Not so much. There's going to be less of that now because those interest rates keep going up. And the refinancing of the debt is refinanced at these higher levels. The annual interest payments for America's $33 trillion of debt, which is already at $1 trillion a year in interest, not paying down the principal, just the interest. That's insane. Of course, this is also going to have an impact on real estate markets. Who the heck is going to want to sell their house? A lot of people locked in 30-year mortgages for like 2.5%, 3%, whatever. They're not selling because if you sell and rebuy, you're now looking at a disgustingly high mortgage rate of like 7.5% or 8%. Double payments every month. Huge financial burden borrowing at that level. People are still buying houses. Don't get it wrong. But a lot of the investors are playing it safe right now, and it will definitely impact the sale of people who already have homes. People will need to move. People are still going to buy and sell properties and all that kind of stuff, right? But this definitely has an effect. Corporate financing slowing down. Again, as we just mentioned, that's going to be a big effect of the higher for longer reality. That has a big impact because when businesses aren't expanding, they're not hiring new people. In fact, businesses might be contracting due to their debt obligations and, of course, slowdown in consumer spending due to all this stuff happening, which means they might be firing people, which means that there could be a rise in the unemployment rate. Now, unemployment is already going up, went up from 3.3 to 3.8%, so a decent jump. I'm pretty sure those are numbers. That could continue higher as all this other stuff works together to grind the United States economy potentially into a recession. Not definitive, obviously, but a lot of indicators are saying we might be having a recession coming in the not so distant future. Keep an eye on that, of course. And that, of course, all boils down to a big risk-off environment for equities, magic internet money, all that kind of stuff. And we have seen massive rallies, right? So here's the thing that's hard to understand with markets is that you can have all that stuff happening and then realize that the people at the top, the people who actually invest, the top 10%, are still going to have plenty of money, are still going to take risky bets on equity markets in a higher for longer environment. Once we have the certainty from the Fed, this is what's happening. We are going to be in a higher for longer situation. People can actually say, well, we have certainty in the markets. This is the new normal. Let's just go ape into stuff and see what happens. But those recession fears and the uncertainty factors around all this stuff are definitely going to keep weighing heavy on the markets. Okay, that's it. See you next time.